Morning. This morning we're focusing on getting your business exit ready to maximise value. Good to see so many of you. Always a hot topic, this one. My name's Esther Carter. I'm one of the partners at Moore Kingston Smith, and I'm going to be doing a bit of light chairing today. I'm sure lots of you are pretty familiar with who we are. We do see regular faces on these webinars, but for those of you who aren't, Moore Kingston Smith is a leading audit, tax and advisory firm, and we work with businesses across lots of different entrepreneurial sectors, as well as not-for-profit and private client. And we're also part of More Global, which is an international network, so very well placed to serve your international needs as well. So if you're considering a sale, it's probably going to be a one-time event. So it's really important to get it right. It's really important to maximise that opportunity, to maximise the timing at which you sell, the value for which you sell, and the buyer to which you sell to as well. So understanding that the key value drivers that sort of all feed into that process is really important, and also generally good for business health as well. And it, I mean, the M&A market has slowed down a bit, but it's never too early to start planning. So today we're joined by a panel of experts who are going to give us their thoughts as to how we can really maximise that process, and make sure that we're on our exit roadmap to make sure we are successful. So today I'm joined by Nick Thompson, who is Head of M&A at Moore Kingston Smith, Mike Orton, who is Head of Transaction Services at Moore Kingston Smith, and Dave Coates, one of our M&A specialist tax partners. So before we start, a little bit of housekeeping. This webinar is for you, so let's make it interactive. Please ask questions, that way you get the most out of it. Please ask them in the Q&A function, because it's a lot easier for me to keep track of the questions there, and I'll try and pose them to the panelists as we move our way through. The session is being recorded, so please do share it with your peers, anyone who is unable to make it today. Obviously we're keen for as many people to see it as possible, and there'll be a little short feedback survey after we finish. Please fill it in. It's really short, and it's super helpful for you to fill that out to help us shape future webinars. So starting off with some questions then. So Nick, I mean, just probably coming to you first to give us a bit of a sort of a broad overview of what you're seeing in the M&A market at the moment.
Sure, thanks Esther. Morning everyone. The M&A market has been a bit odd for the last 6 months. Since COVID, we had bizarrely, and it's difficult to explain why, really buoyant market. Deal volumes were higher than they've ever been before COVID. And I know COVID seems a long time ago, but the sort of 21, 22 was excellent. 23, there was a bit of uncertainty with interest rates, that kind of thing. Some madness in our government, but last year was strong across most sectors, building up to the budget. And when I talk, I'm probably talking about the lower mid market. So that's deals under 50 million in valuation, and so there's a lot of owner managed businesses, low mid market PE houses, and so there's a big push before the budget. What we've seen then is things really slow down. So Q1 deal volumes were really low, much lower than they had been for the last couple of years, and that's because a number of factors. There's been tariffs, wars, a lot of uncertainty in the market, and some of those announcements in that budget impacted valuations. The NI changes overnight wiped off significant value of people-based businesses, and so owners were more focusing on themselves and their business than looking at selling. What we've seen in Q1 and Q2 is there's a lot of PE bolt-ons, a lot of off-market deals, so less full processes, shareholders wanting to go and market their company for sale, but the deals have still happened. We've been pleased in the last month or so. There seems to be a bit more appetite to have conversations by business owners about looking to sell, but I don't necessarily think that's going to be rushing to market in the next month or two, more like sort of later on this year. So we're not expecting a massive 25 either.
Mm-hmm. Thanks Nick. I mean, and just sort of obviously people always got one eye on the tax situation when they're looking to sell. So I mean, what do you were sort of expecting to see any tax related changes in addition to the ones we've already seen over the next 12 months, which might impact M&A decisions?
Yeah, good morning, everybody. And I think Nick probably touched on it a little bit there. It's tax has probably been a bit of a driver behind a slightly uncertain M&A market in the last couple of years, certainly. And I think it's hard to escape the daily reporting and rumour mill of tax rises and how the government are going to take control of the ever increasing borrowing. So I think tax is going to play a fairly big part in how buoyant the M&A market will be over the next 12 to 18 months. And that's not, I think a lot of people focus on capital gains tax and what might happen there, because that is the direct cost of selling your shares and has the biggest impact on, for sellers, how much cash they'll retain from a sale at the end of the process. But as Nick said, things like national insurance increases, which are sort of a bit of a stealth problem for things like M&A, because actually they have a direct impact on the business's profitability, which when you consider a multiple of that, when you're looking at an exit value, can really, really stagnate a market quite quickly as businesses try to rebuild the profitability around having to take that hit to the profit and loss account. So yeah, and obviously as we move through some changes that have already been announced at the lower end of the market, people will still be quite focused on the business asset disposal relief change. So we've already moved from 10% to 14% in the current year, and that moves to 18% from April 2026. So at the lower capital market and lower value sales, I suspect there'll be people trying to force those deals through pre-April 2026. But actually, in the grand scheme of things, a 4% swing now on business asset disposal relief has a maximum cash benefit to people of £40,000 on a £1 million lifetime allowance. So it's not going to be a deal breaker for a lot of people. So there's still lots of moving parts, and I think a lot of it is still yet to be seen as to how the Chancellor addresses the increasing cost of borrowing, and whether she uses taxes to plug that gap.
Do you see capital gains tax rates aligning with income tax rates, which is what we all feared in the last budget?
Well, I say to clients at the moment, my concern is that from April 2026, we have effectively a 6% differential between the worst case capital gains tax rate of 24% and the best case of 18%, which I question how long that is sustainable for. It's not a massive variable in terms of the best possible rate you can get for selling an asset and the worst. So the Chancellor has clearly already made a move to bring the 10% rate up to 18%, and I don't see them immediately looking to rectify that position and bringing that down. So the logical answer would always be, I think that top rate of 24% may start to creep up at some point.
Yeah, absolutely. And Nick, what are your views on sort of the outlook for the years ahead, and really sort of what are the things that people should start thinking about early doors if they're looking to sell?
Yeah, as I said, I think and this is not just us, other advisors, we do talk, we're actually friends. We're not expecting a massive 25. People are always going to want liquidity events. People will retire, people will have plans for growing and selling a business. So deals will continue, and they will continue into 26. And we're confident that they will, go back to where they were, for sure. I think what we're seeing, I know it's a bit topical because of the subject of this webinar, but being prepared is vital. So, in the context of when we're talking about off-market deals, that's when someone might come knocking on your door saying, we'd like to buy your business. You don't know when that's going to happen. So being prepared for that eventuality is vital. But also, these sort of periods of quiet M&A where maybe valuations aren't as high as they have been, and demand from buyers isn't quite the same. It's a great period of time to focus on your business and making it look perfect in the window shop when the time comes.
So from a sort of practical point of view, then what is it that business owners can do to sort of start planning and getting ready for an exit?
Yeah, I mean, a lot of these things really align to running a great business as well. It's not just about focusing on exit, because having a great business means you're fairly well prepared. Most businesses are valued on a multiple of profit. So you've got the profit maximization point, which is operational efficiencies, and maximizing sales, your BD approach. that all leads to increased profitability and is something you should be trying to do anyway. But where you've maybe got some extra costs that aren't really necessary for the business, maybe there's some lifestyle expenses in there, really need to get those sorted and removed, because although some can be added back when a deal comes, you really want to have a clean set of financials, which I'm sure Mike will touch on later. In terms of the multiple, there's quantitative and qualitative factors that drive where you sit on a multiple range. So, are you a 6x or a 7x or an 8x? That is subjective, but there's a lot of factors that come into that. So you could have owner dependence or customer concentration. If you've got diverse customer base, is it recurring revenues or project revenues? Your talent management as well, MI and your financial controls and processes, all of those, and I know there's quite a few there, how you perform against your competition will determine where you sit on that valuation multiple range. And there's a disproportionate impact by moving up that range on your valuation compared to increasing profit by a pound. So looking at all of those factors is key.
And of course, optimizing those key value drivers will not only improve your profitability and nudge your multiple up, but will also sort of widen the suite of buyers that might want to buy you, which sort of leads me nicely into the question that we've been asked about EOTs. Somebody said, I'm seeing a massive increase in interest for EOTs. Are you seeing that as well?
Yes, fundamentally. Yes. EOTs, and maybe Dave's best place to talk about some of the more technical elements, but just in terms of an exit option, they're very attractive to sellers, particularly in a quieter market. A lot of EOTs are vendor financed, so that's when it's an IOU from the shareholders essentially, and they're great for people-based businesses, things like architects where there's no obvious buyers. There are quite a lot that are probably being done for financial restructuring and tax planning purposes, as much as commercial ones. But Dave, do you want to?
Yeah, I think we always say to clients, and EOTs are very, very common on agendas when discussing possible exits now. And I think they certainly suit certain situations where there isn't a buyer, but I think because they are quite often vendor financed, i.e. the sellers get paid out of future profits of the business. They are incredibly reliant on having a good, strong management team in place to be able to drive the business forward. And I think there's certainly been a lot of cases in the past couple of years where people have used it because of the tax incentives and are now finding that those ongoing payments are quite difficult to service because they've taken the foot off the gas a little bit. The management team weren't quite ready to drive the business forward, and a lot of these people that sold to EOTs are now having to come back into the business and actually get to grips with it again, which wasn't really their intention at the point they sold to the EOT. So certainly they have their place. They're becoming very, very popular and common, not just because of the tax benefits, because they do give a very nice, clean exit route to people where there's not an otherwise obvious exit route for them.
Yeah, particularly in the marketing services space, which is where I sort of specialise, they've become incredibly popular, and we've done a lot of EOTs over the last few years. And a little plug, I suppose, I guess that one of the benefits of coming to us to do EOTs is that we can do complete full service. So we can do the valuation, the commercial input, the tax advisory, but we can also do all the legal drafting as well because we've got in-house legal. So yeah, definitely an increasingly popular choice. So Nick, I think we might come back in a little bit more detail on some of these key value drivers, but before we do, Mike, might be just sort of worth just coming over to you, given that you haven't had an opportunity to speak yet, and just sort of maybe talking a little bit about the things that sellers should start thinking about to prepare for the dreaded due diligence process that buyers put them through.
Yeah, good morning, everyone. I'm not sure I'd describe it as dreaded due diligence. I quite
I
like
can assure you, my
well.
clients dread it. But you're going to tell us how not to dread it.
I think the simple message is, you're going through this period to prepare business for sale, making adjustments to the business, etc. As Nick explained around maximising profitability, adapting the business, making changes in the business to maximize the multiple. But when you get to the stage of due diligence, you're in exclusivity with your preferred purchaser. You've got to demonstrate all of this, and you've got to have the information to hand to back up how how you've positioned the business to the market. You can't start too early is really my sort of opinion. When you start talking about selling a business and starting to position it, that's when you should start thinking about what information do you need to prepare. The bedrock of the due diligence process is clean, good, financial, relevant information and data. And if that's sort of data that has not been ordinarily prepared for, say, the last 2, 3, 4 years, you need to start thinking about how you're going to collect that data to maximize the value of the transaction. Few examples Nick touched on. If you've got sellers exiting the business and the impacts that might have on profits, etc., you need to be collating those costs together, pulling those out of the numbers, demonstrating the adjusted profit numbers, etc. Nick touched there on the diversification of a client base to try and enhance the multiple. Again, that will need data around clients, customers, etc., to be able to demonstrate that and that shift in the business, and that there is enhanced value there from the changes that have been made. I think it's thinking about really the data you're going to need throughout that process of preparation.
Thanks, Mike. So maybe Nick, just sort of coming back to you on those key value drivers, it'd be interesting just to hear a little bit more detail on some of them. So perhaps picking up on the owner reliance point first.
Sure. So owner reliance, you've got to think when you're selling the company, you're selling the company, not yourself. For a lot of deals, the existing owners, shareholders will be leaving straight away or in pretty short order after some kind of handover or maybe earn-out period. And a lot of owners, it's their this is their baby, it's their number one asset. They've founded a company, they work, live, breathe it, and it can be quite hard to detach yourself. And so make yourself redundant essentially is the message. Prospective buyers want to see a strong management team to drive the business after your exit. They might not want to keep that management team, but that's sort of their prerogative. What they don't want is the business to be completely reliant on you as a shareholder essentially. And this can be a real struggle for owners. We often say to our clients before we go into management meetings with potential buyers, just underplay what you do, don't over egg it. And every single time they'll go in there and basically say, "Oh, the whole thing would fall apart without me," and because they think that's what buyers want to hear, because they want to feel like they're important, but they are important. But that's part of the planning.
How do you know if you've achieved that, though, whether you've sort of achieved a senior leadership team that can survive without you, and how do you prove that to a buyer?
So there's a few ways. We always say to our clients, sort of, if you go on holiday, does the business run without you? That's a bit of a litmus test. I've heard people be asked, how many emails do you send a week? When there's a client who owns a business saying, "Oh, I only work half a day a week," but then it turns out they're actually sending 2,000 emails a week and constantly engaged with the business. So it's really, preparing, having this management team. It's obvious they run the business. It's not just job titles. There's some bits about incentivization and things like that maybe Dave could touch on around EMI, but showing that they really are. They've got skin in the game, and it's their business, not just the shareholders.
I mean, you touched on EMI there. I mean, often, buyers will expect the senior leadership team to have some equity within the business. And these things can be quite tax driven, can't they, Dave? So perhaps worth coming to you to sort of talk a little bit about how owners can go about incentivizing their key senior leadership team.
Yeah, sure. And I think, as Nick, you said, it's quite important visually sometimes for these management teams to have skin in the game, so to speak, and to have equity. And once a business is established and there's already value in the business, it's quite difficult to get shares directly into the hands of these employees without triggering some fairly onerous tax charges. So that's where sort of tax approved share option schemes, particularly EMI, where it is available, become sort of very, very beneficial to businesses and shareholders because of the tax advantages that come with them. Actually, it's gives the ability, particularly when you do these fairly on in the process, to lock in a fairly low exercise price and agree that with HMRC in advance, which gives certainty over the tax position up front. And then actually, when they're clearly communicated and explained to management teams, although there's no sort of cash return to them straight away, this is a slightly longer term play for them to see the business through to an exit. They can clearly see there's some fairly significant upside potential for them, which keeps them engaged, keeps them incentivized, and more importantly, sometimes as well, retains them within the business. Where and we would always usually look at EMIs as a starting position. Where EMIs, for whatever reason, aren't available, or some people specifically prefer to have an equity instrument in the hands of their employees. Things like growth shares can be quite commonly used. They are probably, well, for many reasons, not quite as advantageous as EMI. Growth shares will be a specific class of share in the articles of the company, which basically have a right attached to them, which say that the shareholder of that class of share will specifically benefit from the growth in value of the company from a hurdle set in those articles. Now, they don't get the same certainty around valuations with HMRC that you get with things like EMI. You can't go and ask HMRC for approval of it in beforehand, so you do open up a sort of a slightly more uncertain world for the future taxation of those. But in the right circumstances, they are very, very much fit for purpose and quite commonly used. But again, with all of these things, it's timing. Get them in early, get the staff incentivized, lock in a low valuation, and actually then allow them to flourish and be incentivized to grow the business.
Absolutely. And what about sort of, Nick, I mean, talent management more generally? What are buyers looking for there?
Yeah, I mean, so you've obviously got your senior management team, but the people in the business often are one of the key assets. And so buyers want to see engaged employees that are aligned to a company vision, the ambition, the positioning. M&A can be unsettling for employees. So being able to evidence that you don't have a load of employee churn and you've got good retention rates will generally make buyers feel more comfortable that they'll find there'll be some natural attrition, but people are pretty settled. Also, having a good track record of successful recruitment is vital. You don't want to be buying a company where hiring managers keep on picking duds, so even Glassdoor ratings and things like that, which are different, you shouldn't manipulate. But if you've got good people leaving who are happy but leaving for other reasons, try and get them to leave reviews, things like that. It sounds silly, but buyers do check it.
Dave, do you want to add anything to that from a sort of tax perspective?
Yeah, I mean, obviously I touched before sort of around EMIs and equity incentives, which I think are fairly crucial in getting people engaged and aligned to the company vision and sort of what the journey might look like to an exit. But I think as well, it's quite often actually realizing what individual drivers are for people. I mean, equity incentives are great in those situations. They create that long-term buy-in. But the downside to a long-term buying is people only receive or realize the cash benefit of that long-term buy-in at some point in the future. And actually, we see it far too often where people go into processes around EMI thinking this is what everybody wants because it's going to put some big numbers in their hands potentially in the future. But a lot of people at the various stages of life will value a cash incentive on a more sort of regular basis as being a more value driver for them personally. So I think it's probably key to really understand what's driving your management team, what their incentives are, and then putting in place a remuneration structure that works for them. It's not just everybody wants to be driven by an exit event in the future. Some people just prefer the value of it now.
Yeah, absolutely. Nick, earlier on you sort of touched on client base and diversity of clients. How important a piece of the jigsaw is that from a buyer's perspective?
It's really important, and it's really, really difficult for lots of businesses for different reasons. So, there's in the dream world, your business would have long-term contracts, 80/20, some big clients that are a nice tail that doesn't go on for too long. But the world's not perfect. And as businesses grow, if you've got a client or customer who is sending you a lot of business, you're going to service that. You're trying to grow. You need those profits to hire more people, get more clients. So it's very challenging depending on the sector and the stage of growth and the journey the company's at. But the key thing is, if you do have client concentration, customer concentration, it really needs to be able to evidence that there's multiple touch points within that organization. Ideally, you've got different people in your business speaking to different people, different departments and different levels in that large client, and being able to show that, because that will give a little bit more confidence to a buyer that you are sort of more embedded. Having that data as well is quite a big one in terms of churn. So, Mike, I think it's probably worthwhile you sort of explaining what the perfect data set to be able to provide a buyer for in due diligence for clients, customers, churn, that sort of thing.
Yeah, absolutely, Nick. It's a key area in almost all due diligence that we do. We get asked to look at revenue by client customer over an historic period of time, who the key relationship holders are, what are the key financial terms within contracts. So the more data you can collate to demonstrate the shift in that mix, the better in reality, especially if you're trying to present a picture where you have reduced some reliance on key customers to try and drive value in the deal. Other areas we'll dissect customers down into geography, sectors, etc., to see where the focus is, where the reliance is. Touch points with customers there, and client customer relationships is an interesting one, Nick, because alluding back to a point you made earlier about owners, they quite often feel that the right thing to say there is that they own all the relationships and they're all on top of it. Whereas, as you just mentioned a minute ago there, that it's trying to demonstrate that you've got numerous people with numerous touch points, you're really embedded in those customers. So trying to get that across is quite important as well. So again, I allude back to a point I made earlier, starting to collate this data early on, because quite a lot of businesses don't collate it to that sort of granular sort of level to be able to demonstrate the direction of travel is really important. It may sound strange, but we go into DDs, we ask for information around clients and customers, and quite often they may not even have a breakdown of revenue by client and customer, and the amount of times it doesn't reconcile into financial statements and management accounts would surprise a lot of people, I think, on this webinar. And that just creates a lot of uncertainty during the due diligence process and that phase of work, which is pretty unhelpful.
Yeah, absolutely. So I guess finally on the key value drivers, Nick, we talked about the importance of good management information. Perhaps touch a little bit more on what good looks like, what a buyer expects there.
Yeah, well, Mike probably can go into a bit more detail, but from an advisory point of view, 100% the number one reason that value gets left on the table or there's price chips after heads of terms when a deal is agreed is poor financial information and records. It happens in most deals, to be quite honest, to some extent. It's you've got the examiner marking the homework, but there's scruffy handwriting, and it doesn't make the examiner feel much confidence in the business. And that then reflects in the mindset of them and the people doing the DD to pick at faults. I think the key thing to remember here as well is all of this is vital for running your business the best as you can as well. It's information that you should have at your fingertips to make decisions. And we often hear CFOs or FDs say, "Oh, our numbers are perfect. We cruise through audits every year." In an audit, what Mike was just talking about there, about having breakdown of clients and churn, audit's not checking for that, but DD is. So, be self-critical and really challenge, is it good quality information? But Mike, do you want to maybe, what does good look like?
Yeah, I mean, a sort of typical DD process, a buyer will want to look back 2 to 3 years, to understand, the historic performance of the business, linking into, what is the underlying profitability, which links into the valuation that you mentioned earlier. And they'll also want to look forward a similar sort of period of time, 2 to 3 years. So having projections, forecasts, etc., in place, underpinned by realistic assumptions, is really the starting point and the bedrock. And it's having, it's all the simple things, or what you might think is simple, of having all your management accounts in place. Do they reconcile to statutory accounts? Have you got all the the reconciliations behind that? Stock listings, customers information we just talked about, trade debtors listings, trade creditors listings, all those reconciliations. And I think also, if you build that up over time in that preparation phase, being ready for the DD process to start is quite a sort of subtle advantage you can take from that. If you get into exclusivity, DD phase starts, and it takes you 6, 7, 8 weeks to pull the information together that the DD providers are asking for. That creates the wrong perception around the financial, the sort of accounting environment, and how good the process and controls are. So being ready and on the front foot and having a data room ready of all that core information, which any DD provider is going to ask, the management accounts, those reconciliations, stat accounts, etc. If you can have all that in place and be ready to almost push the button and open that data room, that is a really solid place to start from. But like I say, simple checks can go a long way, making sure things reconcile, tie in, and you're not then scrambling to produce information during the DD phase.
Yeah, I mean, I guess as well as the sort of commercial and financial due diligence, there'll be some tax due diligence as well, won't there, Dave? What sort of things do we need to start thinking about ahead of that?
Yeah, I mean, from the financial perspective, I think a lot of the time when we do either buy-side due diligence work or helping sellers through the due diligence process, a lot of the problems are created financially when there's sort of a blurred line between sort of business funds and personal funds, and people will see sort of the business bank accounts perhaps as an extension of their own personal money. And I think having sort of financial teams or limited financial teams in a business that understand the tax implications of using company funds personally and how they're reported, quite often that's where a lot of our problems arise. And it's difficult because a lot of these things in isolation are not big problems. The tax consequences of them are not huge to the company. But when you have sort of multiple discrepancies in a year over multiple years, the numbers do add up. And I think going back to the point Nick made earlier, it just gives off an impression to a buyer that there's sort of a poor level of financial control within the business, and it kind of takes away the confidence a buyer might have in what they're buying. And then sort of more around sort of the documentational points, I think getting into a routine of sort of good corporate hygiene practices are quite important from a tax DD perspective. So documenting dividends properly to show a clear differential between sort of salaried remuneration and actual dividend distributions. Looking at sort of the engagement of contractors in a business, making sure that's documented correctly, making sure there's a clear justifiable basis for not operating PAYE on third-party contractors. These are all fairly common things that come up in DD processes, which actually a couple of years out from going into that process, getting your ducks in a row and making sure things are documented tightly and correctly, I think just save a lot of headaches in that DD process.
Thanks. So obviously what we've been talking about up until now really is buyer initiated due diligence, whether that be commercial or financial or tax due diligence. And the message we're hearing really loud and clear is get prepared for that early doors, set up a data room, anticipate the questions. But Mike, there are other forms of due diligence, aren't there, called vendor due diligence, which people probably are a bit less familiar with. So maybe talk us through what vendor due diligence is and what the advantages of doing that are.
Yeah, so vendor due diligence is initiated by the sellers. It's done typically in the run up to going to market. So you have a due diligence report ready to share with prospective purchasers in and around the time or shortly after the time that the business has gone to market. So I mean, in reality, what the sellers are doing there is initiating the DD, which will be akin to what someone on the buy side would do anyway. So you're almost sort of commissioning someone to do the DD for the buyer. The advisor maintains their independence, because what they ultimately do is sign a duty of care to the end purchaser to make sure that the report is robust and prepared on an independent basis. It typically works best where you're selling a business that is making more than 1.5–2 million EBITDA. And there are some really key advantages to it for sellers. So you'll get an assessment done of the business, and that will highlight risks, issues that can be addressed before you go to market. So you're not resolving issues through the negotiation phase and under the eyes of the buyer. It can give sellers, therefore, greater control over the timing and the actual process. It can streamline the process because a large chunk of the DD that the buyer's going to want to do has already been done sort of for them. I think the other key advantage is because buyers, when they're assessing the business and getting under the skin of the business to think about, do they want to put an offer in, they're more informed. So they can make more informed decisions that could get more offers on the table and create more competitive tension, which obviously helps in driving up the price on deals quite often. And I think probably the last as a main advantage is that once you do get into exclusivity, it can greatly reduce the time of the due diligence process as well, because a buyer will only really normally just do some quite targeted top-up DD. So they might look at recent trading. If another quarter has passed, there might be certain risks identified in the vendor due diligence report they want to dive a bit deeper into. So there are some really distinct advantages to it. A slightly alternative approach is something that we call vendor assist. So if you remember what I said there, with the vendor due diligence, you give a formal duty of care to the buyer. With vendor assist, this is more relevant for businesses where the finance team or the management team might have limited bandwidth in terms of getting prepared for the process. They might need some help with enhancing the financial information, pulling certain data together ready for the process. So with vendor assist, that's where advisors almost become an extension of the management team to a certain degree and work very closely with the finance team to prepare information and pull that together. Again, a report is produced, but what's also produced here is a detailed financial fact book. It typically gets called. So that is a whole bunch of analysis, data, graphs, etc., that gets shared with buyers in the fullness of time for them to use in their due diligence. But because an advisor has played a part in preparing it, a formal duty of care isn't given. So it doesn't necessarily streamline the DD process as much. But what it does do is you've got an advisor sat along the finance team, really homing the information and targeting it in the right areas, and also pointing it sort of in the right direction as to what DD providers might need and how it will enhance potentially the value of the deal.
And Dave, presumably this is equally as relevant from a tax perspective as well. One can get prepared on that front.
Yeah, quite often sort of vendor due diligence processes are sort of finance and tax being sort of the main key areas that a possible buyer might want to look at beforehand. And I think we follow a very, very similar process to what Mike just explained. You have the sort of the more traditional sort of larger scope vendor due diligence, which ultimately a buyer will take a degree of reliance upon that on completion. So it really, really streamlines the DD process because they will only really want to look at very specific points that have come out of that report in any greater detail than what you've already presented, because there's a degree of reliance they're going to be taking on our work anyway. And then there's the actual sort of the more fact book style reporting, which is used from a tax perspective. We quite often do these in sort of a fairly competitive process where you want to give multiple potential bidders sort of enough information to make an informed decision on what the tax position of the business is. But usually once the preferred bid has been identified and they're moving forward in the process, they will do either a full scope due diligence themselves, or they'll do a form of what they call top up due diligence on taking some specific areas of our work and then delving into them in a much more detail than what we've done. So there are a couple of sort of options, and they're both more aligned to when businesses are actually now starting to go to market. They're at that stage of now looking for an exit. There is still sort of a process, probably usually sort of within the 18 months to 3 years out from an exit from a tax perspective, where we start to work quite closely with businesses and their owners in terms of trying to plug and identify some of the common pitfalls on the tax due diligence and trying to rectify those in plenty of time, so that when we do get to this stage of doing a DD, there's no sort of scary surprises or things that are going to pop up that might sort of impact the financials of the transaction for them. All of the areas that could possibly crop up are known at that point, and where possible, they've been dealt with and corrected.
What about, I mean, so we talked about sort of incentivization and equity options. Are there any other sort of tax considerations that we haven't touched on thus far that owners need to consider before selling?
Yeah, I think the other thing that probably think about things that pop up at sort of deal stage that I kind of think probably should have dealt with this a bit earlier. It's sometimes it's understanding what a future buyer might actually want out of this business. So quite often we'll be going into transactions where there's maybe like an investment property in the business, or there's a trade that's it's probably differential enough from the main trade that a buyer's not really going to want to take that on. There might be a subsidiary in there doing something else. It's starting to look at the holistic picture of the business and start to think, well, actually, what am I going to be taking to market? Because there's plenty of things you can do with time to sort of carve out bits of the business or carve out assets or investments that aren't going to be relevant to a future sale in a sort of tax efficient way. But the problem is a lot of the time these kind of come to light and crop up sort of in the backdrop of looking to sell the business, and there's a buyer on the table already, and we have to do things in a bit of a rush and push things through. So yeah, I think actually it's starting to get a bit of a holistic idea of this is the business now. This is what I think we might be looking to sell in the future. This bit isn't really relevant. Let's get that out the group. Let's get that out the structure, and starting to do some of that sort of corporate restructuring work in plenty of time.
What about if the business, is a group of businesses and we've got minority interests sort of sitting in and around the group? But what's the buyer's attitude towards that? I mean, for any of you, really?
But I think from a tax perspective, I think it depends where those minority interests sit. So then sometimes if they're in subsidiary entities, and obviously the buyer is going to be buying the main parent company at the top of the group, it can become quite fiddly in terms of having to, obviously a lot of these people are probably incentivized by an exit event, but aren't actually going to be directly party to the SPA that sells the main parent company. So it's having to put in place some legal structures that allow them to actually sell their shares in the subsidiary. So yes, from my perspective, when I see this, it's not buyers aren't put off by it, or they're not. It's not a deal breaker for them, but it just adds sort of layer of complexity that, again, if we were looking at this probably two years out from an exit, looking at this, well, actually, is this person really incentivized by having their shareholding in that entity rather than up here? We could probably look to work around it and make that process a bit simpler.
Yeah.
Yeah, just to add to that, I think if you've got sort of silent investors or shareholders with tiny minorities, in the top co, it's just noise and hassle for a buyer that they'd rather not exist. And if there are options or ways to buy back those shares or get rid of the minorities a few years out from exit, you might have to have some anti-embarrassment clauses and that sort of thing, but it is preferable, really.
Yeah, to get them out, or making sure that your shareholders agreement's got things like drag and tag clauses in it, so that they can't be a blocker for a deal. We had a question come in, probably one for you, Dave. I'm assuming the person asking it is sort of coming at it from a tax angle. He said, as the co-founder of a US business, but who is a UK citizen, are there any particular efficiencies I can plan for now that will improve my exit outcome?
Yeah, so I mean, I think probably working on the assumption that when you mention you're a UK citizen, you're not also tied to the US tax net at all, and that you've sort of always been a UK resident, because the US is one of those jurisdictions where once you're in the tax net, it's very difficult to ever get back out of it. So yeah, assuming you are a UK tax resident and you just hold an interest in a US business, I think the main things is there's no golden bullet here, assuming you're going to remain UK tax resident, but actually making sure that your holding is going to qualify for business asset disposal relief. A lot of the planning and sort of tax savings or we could generate are then largely deal dependent. If there's going to be sort of earn out structures, rollover of shares into new structures, making sure that you're only ever going to be paying tax on cash that you receive, not on rollover consideration. So yeah, I think at this stage in the build up to an exit, it's making sure that actually you've got qualifying holdings, things like business asset disposal relief are the main things to be looking at.
And I guess as well, inheritance tax, once you're liquidating your business assets into cash, maybe not quite such an issue as it was before with the changes, but it is something to have an eye on.
And that's going to become a big thing now, because obviously people always had the comfort of knowing that if they had shares in a trading business and they were to pass away, they would have full exemption and relief from that. Equally, on the other hand, if you sell your business and you realize cash, there's no relief anymore. You've got an asset as in the cash that's subject to IHT. And now we have this weird middle ground now where there is some relief for holding shares, but not full relief. And I think this kind of goes back to sort of the very, very start of the webinar where we discussed about what tax things might impact the M&A market. I think people will start to look at share sales in a slightly different way now, because it's not fully incentivized to hold them through to passing away now. There is not that carte blanche exemption from IHT anymore.
Yeah, absolutely. Okay, so I think we are nearing the end. So I'm going to wrap up with just a final question, same question to all of you, in terms of what would your top tip be for anyone that's looking to exit in the near future? Maybe Nick, coming to you first.
So I guess it's a bit of an overriding one over lots of those points mentioned, but sort of be disciplined and take the time and plan to take the time to step back from the business and sort of work on it rather than in it. It's very easy through the daily grinds just to stay focused on the latest problem, but actually put some time in the diary each month, make a plan, and then challenge yourself to stick to it.
Super. Mike?
Yeah, I think from my perspective, living in the DD world, it's whilst you're focusing on preparing the business to go to market, keep front of mind as well that in the fullness of time, hopefully you're going to be in a DD process, and start to prepare for that. Make sure you got clean management information, financial records, so you're not scrambling once you get into exclusivity to satisfy not only financial and tax DD providers, but you'll have legal, commercial, tech, a whole bunch of people pulling you in different directions. So use the time wisely.
Thank you. Finally, Dave?
Yeah, I think probably a key thing from what we've all said is largely around preparing early, but I think probably to put a slightly different spin on that, I think the earlier in the process you start to think and put yourself in the buyer's shoes, what in the business does the buyer actually want? Are decisions and documentation going to be viewed by the buyer positively? And I think then a lot of the pitfalls we come across are sort of remuneration structures, for instance, that perhaps are geared from a tax perspective that might not look great from a buyer's perspective. So it's having that sort of mindset of, well, what would a buyer think of my decision here, what I'm doing, what my actions are? And I think having that mindset from a fairly early stage prepares you pretty well for a DD process.
Thank you. And thank you to Mike, Dave and Nick for all of your insights this morning. I'm sure everyone's got some really useful key takeaway points from this morning's webinar. There'll be no surprise to any of you that we do run an exit program for businesses that are looking to sell. And really you should be starting to think about this a minimum of sort of 18 to 24 months before you're looking to realise an exit. So if anyone wants to follow up with the chat with any of our panelists, then please do get in touch. So that brings this webinar to an end. Thank you everyone for attending. Remember, it was recorded, so do share it with your peers or anyone else who missed the webinar this morning. And please do fill out that feedback form. Like I said, it's super, super useful. Other than that, enjoy the rest of what looks to be a very sunny day. Thank you.